a speaker that we had on the schedule, Craig Phillips, was originally planned to be here, but he had a conflict at the last minute, and we have in his place a more than able replacement and key Treasury official. Chris Campbell is the Assistant Secretary for Financial Institutions at the U.S. Department of Treasury. At Treasury, Chris has got immense responsibilities involving regulatory oversight over banks, insurance companies, GSEs like Fannie and Freddie, securities firms, and mutual funds. In other words, Chris is in charge of just about everything at Treasury. Right, Chris? No, almost. Chris comes to the Treasury Department after serving 6 years as a staff director of the key Senate Finance Committee. Now, folks, this is what we care about a lot, the Senate Finance Committee. Talked about private activity bonds before, and I just got some information, some good news about the Chairman Hatch's mark that came out, or amendment that came out today, manager's amendment, which includes a plus up in LIHTC. So thank you, Ron Terwilliger, and thanks for all the advocates who have stayed at this. We have some good news coming out of the Senate, finally. Yes. So Chris was at the Finance Committee, so he knows how Washington works. He knows how the process, he knows how the legislative process works, and he built a reputation as one of the most effective staffers on Capitol Hill. I can say that from firsthand knowledge. To say that Chris is busy these days would be a vast understatement, and we are very, very grateful for him stepping up and taking the time to fly in to join us to discuss the future of our nation's housing finance system. Ladies and gentlemen, please extend a warm Motor City welcome to Chris Campbell.
Thank you for that warm introduction, Rick. I appreciate it very much. It's a pleasure to join you this afternoon to discuss what an ongoing policy challenges in our housing market. That is the future of housing finance reform. Thanks to Ron for putting this conference together, and the Terwilliger Foundation has played an invaluable role organizing important policy initiatives and convening cross-section of thought leaders across housing and finance for years, something that we pay particular attention to at Treasury. I'd like to cover two things today with you as it pertains to the Treasury's efforts to ensure access to housing for all Americans. First, I'd like to review Treasury's recent policy recommendations related to regulations affecting the primary and secondary mortgage market. I will then turn to provide the audience with a summary of the Secretary's top-level views on housing finance reform. As many of you know and are already aware, President Trump on February 3rd directed our department, the Treasury, through an executive order to identify statutes and regulations that inhibit the operation of the financial sector under the core principles. These principles align with performance of the financial system with the needs of consumers and business. To recap, the core principles include empowering Americans to make independent financial decisions and informed choices, preventing taxpayer-funded bailouts, fostering economic growth through vibrant financial markets and rigorous regulatory impact analysis, enabling American financial service companies to be more competitive with their foreign competitors, advancing American interest in international financial standard-setting bodies, making regulation efficient, effective, and appropriately tailored, restoring public accountability within the regulatory agencies, and rationalizing the financial regulatory framework. Our work began with discussions involving the experts, a wide variety of stakeholders, including depository banks and non-depository banks of all sizes, credit unions, consumer advocacy groups, think tanks, academics, investors, rating agencies, investment strategists, and many more. In groups of bilateral and individual meetings, we sought to truly understand how regulation is impacting the financial system and how best to address the goals of the core principles. For those of you here today who contributed to that effort, I want to offer you a very sincere thank you. Our first report was released on June 12th of this year, covering the depository system, including banks and credit unions. On October 6th, Treasury issued its second report covering the U.S. capital markets. Our third report concerning the asset management and insurance sectors was published on October 27th, and our fourth and final report is currently underway and will cover non-banks, financial technology, and innovation. This report will cover, among other topics, regulations affecting non-bank residential mortgage originators and lenders. Our research and outreach has honed our view of the core principles and led us to see that the challenges we face through 4 prisms, which I believe are particularly germane to the discussions underway today about the need to address affordability and housing for our country. First, breaking the cycle of low economic growth. Second, better fulfilling the credit needs of consumers and businesses. Third, maintaining liquid markets. And fourth, assessing regulatory burden and impact. Treasury's goals with these 4 reports is not to lay out a roadmap to help Wall Street. Our goal is to guide a regulatory path that helps the financial system better serve customers and the economy. In other words, how can policymakers and regulators better set the dials so that banks, credit unions, investment managers, insurance companies, capital providers, and the market utilities better serve the real economy, the individuals and families at the foundation of economic success and strength for our nation. Furthermore, how can we, as an oversight community, accomplish this important goal without putting taxpayers at risk or lowering standards that are appropriately complex for some of our biggest financial institutions? We have tried to strike a balance between these goals, keeping the consumer and businesses, particularly small businesses, in mind as we explore the impact of regulation. Here are a few important key takeaways. Our reports discuss proposed changes in both regulation and statutes. Some require congressional action, but many do not and can be implemented through our independent regulators. So this is a roadmap, we hope, for both legislative and regulatory policies and changes in the future. There's a lot to do on the regulatory overlap and fragmentation and duplication of regulations. So much can be accomplished by simplifying single paths of regulatory supervision, removing conflict guidance without compromising regulatory purpose. We believe that improving credit flows to consumers and businesses will improve the economy. Credit is plentiful, but not uniformly available and not always available on the best of terms. For far too many qualified consumers, especially home buyers, it is still difficult to get credit. This is due in large part to the regulatory burden causing complexity in loan origination and servicing. This regulatory burden has resulted in less credit and increased costs for borrowers as well as lenders, with the cost of mortgage origination and servicing showing the most noticeable increase since the financial crisis and the enactment of Dodd-Frank. Regional and mid-sized banks, in particular our community banks and credit unions, play a critical role funding communities across our nation and providing local access to consumer credit. Much of our June banking report focuses on regulatory streamlining that helps communities, as regulation aimed at our largest and most complex financial institutions has cascaded far too down, hitting many of our local community banks and financial institutions. Tailoring, quote unquote tailoring, is maybe often an overused word, but our study found that it to be very accurate in characterizing the problem of regulations. Speaking of communities, we're taking a fresh look at the Community Reinvestment Act. The CRA requires a modernized interpretation of how banks interact and serve their clients to define assessment areas. The banking industry has experienced fundamental changes since 1977, and the act must be recognized through the modernization of certain elements of the regulation and implementation of CRA if it's to be effective in the future. CRA has played a significant role in helping banks channel their investments into communities they serve. It is noteworthy that not a single bank has suggested that we seek repeal of the CRA in all of our conversations. However, the world of banking has changed dramatically since 1977, and CRA can have a better and more impact on communities while balancing regulatory review and safety and soundness considerations. I'd like to add a few other points on mortgage lending. One of the core principles, as you remember, is empowering Americans to make independent financial decisions and informed choices. To me, this includes empowering American families to be able to choose amongst core financial products, such as housing, at a cost that isn't prohibitive to their economic well-being. As this group is well aware, there is no magic bullet to revive this challenge. However, one straightforward step would be to ease and clarify regulations governing both the origination of mortgage loans and their sale into the secondary market. We further believe that more private capital and less federal dependence in the secondary mortgage market is conducive to supporting such dynamic national housing market. Such reduction in overall federal support should be accompanied by greater focus on the role of the government in our housing markets, particularly which borrowers and renters need and deserve federal support. However, for that to occur, over time, the private market must be receptive to accommodating a larger share of the market, as it has successfully done in the past. In our June banking report, we reviewed a wide range of regulatory headwinds that are happening across the mortgage supply chain of origination, servicing, portfolio retention, and secondary market. A reasonable amount of these regulations are related to the CFPB, an agency where we make numerous recommendations for improvement. First, we are committed to protecting consumers. In mortgage lending, in particular, it is critical we maintain high standards and do not revert to consumer abuses and layered mortgage risks experienced leading up to the last financial crisis. However, protecting consumers should be thoughtfully balanced with the need to optimize the availability of credit, particularly for individuals and families with less than stellar credit, but who nonetheless have the means and desire to build wealth through home ownership. We believe that the array of regulations, including the manner of enforcement designed to protect consumers, may in effect be prohibiting access to certain segments of the eligible market. In our review of mortgage lending, Treasury noted numerous areas for focus in improving and refining CFB activities. We believe that both the availability to repay rule and the qualified mortgage safe harbor rule need refinement, clarification, adjustment, particularly around guidelines for Appendix Q documentation for borrower debt and income. Changes to ATR QM should include eliminating the inequity of the exemption of the GSE, FHA, and VA eligible loans currently enjoy via the private market. The small creditor QM exemption, which currently excludes institutions with more than $2 billion in assets, should be reviewed and the asset threshold raised to a much higher figure. Smaller creditors with a presence in and knowledge of the local communities who retain loans in their portfolio and that are important sources of credit for borrowers in those communities should be allowed to loan. The loan balance threshold for applications of the points and fees cap should be increased to encourage additional lending in the form of smaller balance loans. Additionally, the CFPB should scale points and fees caps in both dollar and percentage terms for loans that fall below revised adjusted loan amount thresholds. The integrated application and disclosure rules require clarification to foster a greater degree of certainty amongst lenders, and they will not be held in violation and subject to reputational or financial damages for non-material errors in origination process. Additional certainty could also help mitigate the costs that arise from delays in the process and could further encourage the entrance of additional private capital. Because of the lack of guidance, investors take different, often conflicting positions on what constitutes a violation. This results in delays when lenders try to sell loans, and in various cases, lenders ultimately cannot sell loans because of minor technical errors. The loan originator compensation rules need additional flexibility and accountability. Affordable loans may require different compensation structure than other loans, a structure currently prohibited. As a result, it is difficult for a loan originator to offer affordable loans in compliance with existing loan origination compensation rules. On the servicing side, we believe that we should pause the effort to creating new regulation, particularly loss mitigation standards, to succeed the HAMP and HARP era, to take stock of the total regulatory environment and our nation's longer-term housing goals. Our report focused on numerous elements of relief for balance sheet lenders and portfolio holders. For those lenders who choose to originate and sell loans in the secondary market in the form of mortgage-backed securities, in many respects, these are regulatory bias against this execution relative to its risk profile, which needs to be assessed. The issue of improving borrower access to credit is closely related to maintaining lender access to multiple execution options. Private securitization of residential mortgage loans can be an important feature of the dynamic housing market, including the ability for lenders to tap global capital to support the full range of creditworthy borrowers. Regarding impediments to deeper capital markets for mortgage credit, we note several topics, including 1, the need for greater private label security investor protections and clarity. 2, the capital treatment for securitized mortgage products, which often discourages bank investment related to other more traditional funding sources, and 3, Reg AB2 and risk retention rules, which add cost to issuers and discourage securitization. We believe that there are substantial improvements that can be made in the regulatory environment related to the entire mortgage supply chain and that can better serve consumers and maintain the safety and soundness of our financial system. There's ample capital in the market today, which is able to take mortgage credit risk. Easing and clarifying these regulations affecting the origination of mortgage loans is an essential aspect to improving access to a wide variety of credit-worthy borrowers. As the panel following me will be focusing on the future of housing finance, let me take a moment to summarize the Secretary's position on housing policy and his goals for housing finance reform. Treasury recognizes the importance of housing finance and the need to maintain robust and liquid residential finance lending markets. This includes the availability of a 30-year fixed rate, fully prepayable single-family mortgages, as well as which we view as an important element of the future state of housing finance. We look forward to working with Congress to develop legislation for comprehensive housing finance reform. Our vision for housing reform has 3 key elements. First, ending the conservatorships of Fannie and Freddie through comprehensive housing reform. Second, rationalizing the relative roles and risk profiles for all federal mortgage programs, including Fannie and Freddie, as well as the mortgage loan insurance and guarantee programs of FHA, VA, and the USDA. And third, encouraging a vibrant and expanding market share for private sector mortgage lending without federal support, which requires better tailoring of regulations for bank and non-bank lenders, which I articulated a few moments ago. Additionally, the future housing finance system must protect the interests of taxpayers with respect to all federal involvement in housing finance. In keeping with this objective, policymakers should consider an explicit paid-for, full faith, and credit guarantee for federally sponsored conventional mortgage-backed securities with adequate protections such as the guarantee is only drawn upon in exigent circumstances. Post-conservatorship, develop and enforce a rigorous capital regime for all secondary market guarantors, and eliminate or minimize balance sheet usage, funding mortgages with taxpayer support of any kind. Housing reform must also create open and fair access to federal mortgage programs and promote a level playing field for pricing terms, regardless of size of institution or geography. Finally, housing reform must focus on rigorous market demands to maintain a robust housing finance system, including minimizing transition risk to the reform system, encouraging innovation, particularly through the use of technology to improve costs and efficiency, and optimizing global distribution of mortgage securitization debt in order to achieve the lowest cost to consumers. In conclusion, I want to thank you all for your time and attention today. I hope these remarks provide you a framework of where our administration's view on regulatory reform is headed as it relates to the mortgage industry and market, and some of our core principles that we'll be looking through as we develop these policies. Let me end by saying that we have an open door policy at Treasury. As we focus on the coming demands of housing finance reform, we look forward to an open dialogue with many people in this room and others on trying to find the best way, striking the right balance to get to a place where we can make sure to ensure housing for all Americans. Thank you for your time.